There were two charts that got a lot of attention last week in the options space, and they are on your screen here. The first one is from our friend Saqib at Reuters, and as you can see here, if you buy and hold the spiders, you didn't do very well this year. So that's what this maroon line is. However, if you bought spiders but sold it the week into options expiration, that's the third Friday of every month, if you stayed in cash for that week, you can see you significantly outperformed the market, and that's particularly true in the second half of this year, basically after June. And in a related chart that we have on your screen is the holdings or the returns for the week leading into options expiration at the top, and then the week after options expiration is at the bottom. And what you can note is that, yes, the returns over the last 2 years into that third Friday were negative, but particularly this year, they were really, really bad. And I think this 2020 is obviously skewed by the March crash. And then if you held or you bought after that week, after options expiration week, you can see you had just incredible returns this year. So just being in cash or even short the market the week of the options expiration this year and being long or owning spiders the week after, you can see you've had just really impressive returns. Now, why is this? I think there's obviously some caveats to all of this data, like always, but this brings us to sort of a key point that we wanted to bring up. So on your screen here is our net gamma indicator. Now, what net gamma tells you is, are we in a positive gamma regime or a negative gamma regime? For this indicator to be in a positive gamma regime, what you must have is more calls in the market from a gamma weighted perspective than puts. So any of these lines in the past year, 2018 and 2019, as you can see on your screen, there's primarily call gamma in the marketplace, right? There's more calls than puts. This is a call weighted regime, we would call this. And this is generally associated with lower volatility in the market, and that ties into how dealers hedge. Check out any one of our other videos on net gamma and hedging. And if you are below this zero line, so if you flip to negative gamma, that's this number over here, you're in a put weighted regime. Put weighted regimes tend to be associated with more volatility. We believe that's because puts are more sensitive to implied volatility in general, and they have to be more actively traded as a result. So what you can see here is that in 2019 and 2020, on average, we tend to spend much more time in call weighted positions, right? And that was true up until obviously the pandemic crash, and then we quickly rebuilt to a call weighted position, and that weighted position existed all the way up until essentially January of this year. In January, all of a sudden, we broke down and we spend most of this year in a put weighted regime. That means that what tends to happen is that expirations are concentrated in big put positions as opposed to big call positions. The one or two sort of times this year that we didn't have put weighted positions on monthly expiration was really in April and then also in August. And what you would notice if you looked at those two returns specifically, you would actually see the market drop. So we rose into those options expirations in April and August. And then after August and April expiration, the market dropped. Whereas in all these other expirations that were put heavy, there was a big rally, right? And so what generally we believe happens is as puts go in the money, delta hedging positions build from dealers, right? They are short. And then on options expiration, all those puts expire, and there can be a short cover rally as market makers and dealers adjust their positions, and that can often lead to a market rally. Again, if you look at this, April and August, you see there's the only two times that are really different. And if we flip back to Saqib's chart, what you can notice here is that in April and August, both of those expirations, you didn't get that same outperformance, right? There's a topping here and also a topping here. You see that you didn't get that same bounce, right? That being in cash those weeks didn't help you that much because you had the opposite reaction. You can see here again, the strategy performed poorly after April and August expiration. So that's why paying attention to the zero gamma level can be so important, not necessarily from a volatility forecasting perspective, but just what is in control. Is it put options or is it call options? And that can affect the way the market moves around expiration.